A very good day to Dr. and my fellow classmates. We are from Tutorial Group A, Group 1, and this is our group presentation assignment.
Now look at the first question. Evaluate the effectiveness of deposit insurance schemes in preventing bank runs and what are the potential drawbacks. Before I answer this question, first, what is the definition of deposit insurance schemes and bank run? Deposit insurance schemes is a scheme run by either a government agency or a private company which aims to protect deposits of private investors. In Malaysia, PIDM provides protection and insurance for depositors in the event of a bank run in any member institution. PIDM offers protection of up to 250,000, and this protection is automatic as depositors do not have to make a claim and there is no payment to be made. While a bank run is when customers hurry to withdraw their deposits, simultaneously because they believe that the bank might fail. Apart from physically withdrawing money, customers can now transfer their money to another bank online within seconds. A bank run may happen if bank officials state the institution is having financial difficulties or if such information is reported in the media. Now, we evaluate the effectiveness of deposit insurance schemes. First point is increases consumer confidence. According to Keynes, expectations play a role in economic behavior. By guaranteeing a certain amount of deposits, we can manage the depositors' expectation by reducing the risk of losing their funds and reassure the depositors that their funds are safe. This will prevent panic-driven withdrawals, which causes bank runs. For example, during the COVID-19 pandemic, Malaysia faced financial strain and rising unemployment. Despite government subsidies, the market was affected. PIDM's guarantee was crucial in preventing widespread panic, ensuring continued trust in the financial system, and reinforcing the security of. The another example is during the 2008 global financial crisis. Malaysia implemented the government deposit guarantee (GDG) as a preemptive measure to maintain public confidence and prevent bank runs. PIDM administered this guarantee to prevent panic withdrawals and to stabilize the banking sector. The GDG was placed from October 2010 to December 2010, after which PIDM enhanced the coverage limits of the deposit insurance systems DIS from 60,000 to 250,000 per depositor. This increase further strengthened depositor confidence and ensure continued stability. To sum up, the effectiveness of deposit insurance schemes increases consumer confidence is high, particularly when depositors trust the regulatory framework and the credibility of the deposit insurance authority.
Deposit insurance schemes are effective because they help prevent financial contagion by helping to contain the impact of financial crisis to the affected institution, preventing it from spreading to other banks. The reason is that if one bank fails, the entire financial system will lose trust. This is crucial in Malaysia, as the banking industry is so intertwined that a decline in trust in one institution might quickly affect the others. Depositor anxiety can increase rapidly when a bank has financial difficulties. Therefore, by breaking the cycle of fear, the guarantee provided by PIDM offers the general public a safety net that reduces depositors' fees, which in return will prevent needless withdrawals. The second way it prevents financial contagion is through the psychological effect, where if the depositors are aware that their money is safe, they are less inclined to follow rumors or false information. For example, during the Eurozone debt crisis, countries with robust deposit insurance schemes, like Germany, experienced fewer bank runs compared to nations with weaker guarantees. And when it comes to effectiveness, deposit insurance schemes have an effectiveness of moderate to high, depending on the robustness and universality of the scheme. Another reason why deposit insurance schemes are effective is because of the speed of compensation, where a quick reimbursement will act as a confidence booster because it reassures depositors that the insurance system is reliable. When the compensation is delayed, it can signal that the insurance system is not functioning effectively, which might trigger a chain reaction. Case example, the European Union. In the EU, the Depositor Guarantee Scheme DGS mandates that depositors are entitled to receive their compensation within 7 working days after a bank's failure. This quick reimbursement helps maintain depositor confidence and prevent massive panic withdrawals. Deposit insurance schemes are highly effective if payouts are made quickly, ensuring the financial system remains stable by avoiding unnecessary disruptions and depositor panic. But it has limited effectiveness if the compensation process is slow, where delays can cause frustration, which will undermine the very confidence the deposit insurance system is supposed to instill.
Now we are going to talk about what are the potential drawbacks. The first potential drawback is moral hazard. Moral hazards occur when depositors and banks act less responsibly because they are aware that deposit insurance lowers depositors' financial risk in the event of a bank failure. Knowing that depositors are less likely to take their money out, even if the bank's financial situation worsens, the bank may take up riskier lending or investing activities. If risk management procedures are not followed, This violates market discipline and may cause financial instability. Deposit insurance provides a safety net, may cause depositors to place less emphasis on a bank's financial stability and select the bank that offers a bigger return without assessing the soundness of the bank, which encourages even more risky conduct. In order to reduce moral hazard, the Bank Negara Malaysia (BNM) in Malaysia enforce regulatory scrutiny by closely observing banks' risk profiles, implementing capital adequacy regulations, and perform frequent stress tests. The second potential drawback is international challenges. Given that there is significant cross-border banking activity, Malaysia faces particular challenges with foreign deposit insurance schemes. As is well known, Malaysia is a member of the Asian Economic Community (AEC), which encourages member nations to integrate financially. However, Asian nations differ greatly in terms of deposit insurance coverage, regulation, and enforcement. For example, Singapore, our neighbor, has higher deposit insurance coverage limits. It might reduce Malaysian banks' ability to compete for foreign deposits. Confusion and unequal protection for depositors in the region can result from disparate regulatory standards. In the event of a crisis, Malaysian depositors may see unequal treatment for their accounts in nearby regions. To tackle these issues, we should promoting regional harmonization of deposit insurance programs such as Asian Economic Community (AEC) and investigate an Asian-wide deposit insurance framework to guarantee uniformity among member states.
Now, I will take the third part of the potential drawbacks. So the third potential drawback is the cost implication. Banks are required to make recurring premiums to the PIDM Managed Deposit Insurance Fund, which may result in increased operating expense for banks. As a result, the bank net income will decrease, causing them to be unable to grow their business, enhance service, or reinvest in technology. Therefore, the bank might not be able to provide the public with more savings promotion, causing the public to have a lot of cash on hand rather than saving in the bank. Because of this, the public may easily purchase the items they desire, and if the situation materializes, it may lead to inflation. Now, I will take the fourth part of the potential drawback. So, it is a coverage limitation. Coverage limits are the maximum amount of money that insurance policy will pay of a claim. PIDM insure deposit up to 250,000 per depositor per bank, covering both of the principal and the interest that has accrued, and any amount above these limits is not insured. For large depositors, deposit insurance might cause some risks such as the losing funds, facing cash flow problems, and operational disruption. Limited areas of coverage including exclusion from specific financial products and accounts, including trust accounts, investment accounts, and foreign currency deposits. To overcome this problem, deposit insurance should implement the field of insurance based on risk by adjusting coverage based on depositor type. The conclusion of the potential drawbacks is deposit insurance schemes like those by PIDM in Malaysia effectively prevent bank runs by boosting depositor confidence and preventing financial contagion. However, potential drawbacks include moral hazard, where banks and depositors might take on more risk and coverage limitation that may not fully protect large depositors. Lastly, despite these challenges, deposit insurance remains crucial for financial stability. That's all from me. Thank you.
Now we will be moving on to the question 2, and in question 2 we have two parts of question. For first part of question, which is how do monetary policies differ between advanced and emerging economies? Alright, so for the difference regarding the monetary policy between the advanced economies and emerging economies, the first difference is in terms of the monetary policy objectives. So for advanced economies, the objectives will be maintaining the price stability while supporting the sustainable economic growth and employment. During the periods of economic downturn, or we call it as recession, central banks may lower the interest rates. So, for example, aggressive monetary easing by the Federal Reserve following the financial crisis in 2008, which include the lowering interest rates near zero and implementing the quantitative easing to inject liquidity into the financial system. But in the early 2020s, many advanced economies face inflation spikes due to the supply chain disruptions and geopolitical tensions, compelling central banks to prioritize inflation control even at the potential cost of slower economic. While at the same time, emerging economies objectives will be promoting the sustainable economic growth, maintaining the price stability, and ensuring the financial stability while fostering conditions for employment generation and poverty reduction. Central banks typically focus on the controlling inflation through inflation targeting or monetary aggregates, as high inflation erodes the purchasing power and disproportionately affects the low-income households. So, for example, Brazil Central Bank adopts the inflation targeting using the interest rate adjustment to keep the inflation within a predefined range. For the second objective of the emerging economies is to manage exchange rate stability. They will be relying heavily on exports and foreign investment. They will also prioritize the financial inclusion and access to credit, aiming to reduce the inequalities and promote SMEs. So, for example, India's Reserve Bank intervenes in foreign exchange markets to prevent the excessive currency volatility, ensuring the competitiveness in exports while mitigating imported inflation risk. The second differences regarding the monetary policy between advanced economies and emerging economies that we would like to highlight is tools and instruments. So for advanced economies, they will be relying on the sophisticated and diverse array of tools and instruments. And here, we have two types of tools that we would like to highlight in advanced economies, which is first one is quantitative instrument, traditional tools, and the another one is non-traditional instruments. So for the traditional tools, it will be focusing on influencing the overall supply of money and liquidity in the economy. Open market operations is one of the example of quantitative instrument. It will be involving the buying and selling of government securities. When the central bank buys security, it will inject money into the economy, increasing liquidity and encouraging borrowing and spending. So, for example, during the COVID-19 pandemic, the Federal Reserve in US conducted aggressive open market operations, purchasing the government bonds and securities to ensure the liquidity in the financial system. So, for a non-traditional instrument, we will have the example of quantitative easing. It will be involving the large-scale asset purchases by central banks. It will lower the long-term interest rates, supports asset prices, and stimulates the borrowing. So, for example, after the 2008 global financial crisis, the Federal Reserve launched the quantitative easing programs, purchasing trillions in government and securities, which play a crucial role in stabilizing the US economy. Second example is a forward guidance. It is a communication tool where central banks provide explicit statements about future monetary policy action. For emerging economies, they will also have several tools and instruments, and one of it is policy interest rates. And here also have two key rates, which is repo rate, the rate at which commercial banks borrow from the central bank, and another one is the reverse repo rate, the rate at which the central banks borrows from commercial banks. Raising policy rates discourage borrowing and reduce money supply, helping to curb inflation. So, for example, during the COVID-19 pandemic, the South African Reserve Bank reduced its repo rate significantly to stimulate economic activity in the face of declining demand. Secondly is the reserve requirements. Higher reserve requirements reduce the funds available for lending, tightening the liquidity. So, for example, the People's Bank of China has used the adjustment in the reserve requirement ratio to manage the liquidity. So, for instance, in 2019, it reduced the reserve requirement ratio to stimulate the credit flow to small businesses.
The next aspects I'm going to talk about is the inflation control and targeting. I would like to talk about on the advanced economics. It is like the US, Japan, Europe, and the UK typically adopt a clear inflation target, often around 2% annually. Central banks in this country use interest rate adjustment and forward guidance as the primary tools to manage inflation. For example, in the US central banks, they uses the interest rate adjustment to keep inflation close to 2%. If inflation exceeds this target, it may raise rates to cool demand. While on the emerging economics, in emerging markets such as Brazil, India, Turkey, South Africa, inflation tends to be more volatile due to several factors, including external shocks, exchange rate fluctuations, and also the supply side constraints. Therefore, central banks in these economics often face a dual challenge of controlling inflation while simultaneously stabilizing the currency. For example, the Central Bank of Brazil frequently adjusts its benchmark interest rates to respond to inflation, which can be driven by both domestic factors like the wages and also external factors like changes in oil prices or the exchange rate. The last aspects I'm going to talk about is the currency and exchange rate management. On the advanced economics, their currencies like the US dollar or euro are stable because they are widely trusted around the world. These countries usually let the market decide the value of their currency. The central bank rarely steps in unless there is extremely instability. For example, the US dollar remains strong and stable even during economic uncertainty because it is used globally for trade and investment. In my part, I would like to talk about the emerging economics. Their currencies can be more volatile and often lose value quickly due to global factors like investor pulling money out or rising oil prices. When the currency weakens, imported goods like fuel become more expensive, driving inflation even higher. To stabilize their currency, central banks in this country may intervene by using their foreign exchange reserves like the US dollars to buy their own currencies. To give an example, if the Indian rupee weakens, India's central bank might sell US dollar to strengthen the rupee and also reduce inflation. Thank you.
Now we are going to talk about what challenge do emerging economies face in implementing effective monetary policies. Firstly, I would like to talk about the challenge is high and volatile inflation. So the main key causes are supply chain disruption, rising global commodity price, and also domestic fiscal imbalance. As we can see that the impacts are erosion of purchasing power, especially for low-income households, and also uncontrolled inflation expectation hinder monetary policy. Central banks face some challenges, such as balancing inflation control with economic growth. Here is the example of high and volatile inflation. Argentina's 2023 inflation crisis over 100%, hurt low-income families and strained the economy. Driven by overspending and a weak currency, it forced the central bank to choose between curbing inflation or supporting growth. Furthermore, I would like to talk about the challenges exchange rate volatility. The main key causes are weak foreign currency reserve, speculative capital flows, and external economic factors. As we can see that the impacts are currency depreciation, increased import costs, fueling inflation, and also currency appreciation hurts export competitiveness. So as we can see, the challenge that faced by central banks is frequent market intervention, strains reserve, and diverse policy focus. So let's move on to the example parts. For example, Turkish lira crisis. In 2021 to 2022, Turkish lira sharply depreciated due to low reserves and policy missteps, causing soaring import costs and inflation over 80%. Central bank intervention strained reserves, worsening economic challenge. Moreover, the challenge is vulnerability to external shock. The key causes are global interest rate hikes, commodity price surge, slowdowns in major trading partners. As you can see that the impacts that we face are currency depreciation and higher borrowing costs, limited central bank option for domestic challenge. So here is the example for vulnerability to external shock. For example, 2013 Taipei Random. In 2013, when the US Federal Reserve signed plans to reduce bond purchase, capital rapidly flow out of emerging economies. Countries like India and Indonesia face currency depreciation, higher borrowing costs, and inflation, forcing central banks to raise interest rates that start domestic growth concerns.
So the fourth challenge is the underdeveloped financial markets. Just like cause of lack of well-functioning markets for financial instruments, inactive transmission of interest rate changes by commercial banks, and also dominance of informal financial system. This cause has an impact of limited effectiveness of monetary policies and difficulty managing liquidity and credit during the economic stress. For example, the Nigeria's financial challenges. In Nigeria, informal financial system and weak bank transmission of interest rate changes hinder the central bank's ability to manage inflation and stabilize the economy. The next one is the political interference and institutional weakness. The causes of political pressure undermine central bank independence, monetary policy influenced by short-term political goals, and also weak institutional frameworks and corruption. It has impact by reducing the central bank credibility and trust, and even have the challenges in managing long-term inflation expectation. To give an example, just like the Argentina's political interference. In Argentina, political pressures for lower interest rates and higher spending during election years undermine the central bank's independence, hindering its ability to control the inflation. Last but not least, it is in managing volatile capital flows. The key causes of sudden inflows, risk of asset bubbles and economic overheating, rapid outflows, financial market destabilization, and currency devaluation. The impact of difficulty balancing inflation control, currency stability, and growth. Conflicting measures like high interest rates attract investment but hurt the domestic borrowing. For example, in 2015, South Africa faced capital outflows, rand depreciation, and dwindling reserves. Raising interest rate to attract investment, increase borrowing costs, straining growth and inflation control. That is all from us. Thank you very much.